Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and today we're looking at 3 great dividend stocks to buy in 2020 that'll bring you some juicy passive income when holding in your portfolio. A little bit of a bonus today because these stocks are available on both Canadian and US exchanges. So just make sure that you're purchasing these stocks on the correct exchange that's right for you. And if at any point of this video you're enjoying it, remember to subscribe and like as it really helps the channel grow. Before we get into it, if you want to purchase Canadian stocks and pay $0 in fees, click the link in the description below to open your account with Wealthsimple and get $10 free when you invest your first 100. Alright, let's get started. The first stock we're looking at today is Pembina Pipelines. Pembina is found on the TSX under ticker symbol PPL or on the New York Stock Exchange under PBA. They have a dividend yield of 8.05%, which pays out $2.52 Canadian annually. Pembina owns an integrated system of pipelines that transport crude oil, natural gas, and natural gas liquids. They also have gas gathering and processing facilities and an oil and natural gas liquids infrastructure and logistics business. There are 3 sectors of the oil industry: up, mid, and downstream. Pembina is heavily involved in the transportation, meaning their focus is on the midstream sector of the oil industry. Companies that perform in each one of these sectors can have their own competitive advantage. I really like midstream because of the infrastructure required to do what they do. Pembina has very valuable and growing assets. They have an extensive network of pipelines which span over 18,000 kilometers across North America. These assets are extremely valuable, and it's becoming increasingly more difficult to build or extend these types of transportation vessels due to the ever-growing environmental laws. With their gas gathering and processing facilities, they are able to generate enough gas to heat 11.7 million homes every year. To support their customers' overall business interests, Pembina also seeks to create new markets and further enhance existing markets through the development of infrastructure. Pembina undertakes value-added commodity marketing activities, including buying and selling products such as natural gas, ethane, propane, butane, and crude oil, and also focus on optimizing storage opportunities. So now we know a little bit about their operations and the business. Let's move on to the stock quote. What we're looking at right here is the Yahoo stock quote. If you're new to investing and looking to understand the key metrics that you should be looking at when evaluating a stock quote, click the video on the screen now where I take you through a step-by-step guide on how to understand and benefit from this kind of information. I'll also leave the link in the description below. Anyway, for Pembina, today they closed at $31.31. That's down 1 cent on the day or 0.03%. They have a market cap of $17.215 billion. They have a PE ratio over the trailing 12 months of 17.76. Earnings per share is currently at $1.76 over the trailing 12 months. And they've been trading between $15.27 and $53.79 Canadian in the previous year. They have an incredibly sexy 8.05% dividend, which equates to $2.52 Canadian. Taking a look at that dividend growth and history over the last little while, we can see that in 2009, they were paying a 10% dividend, which equated to $1.56, and they are now paying 8.06% dividend, which is $2.52 Canadian. Simply Wall Street is a great tool for all investors, and they offer an estimated fair value based on the cash flows the company is expected to generate in the future. Their fair value estimate is $33.61, meaning the company is currently 14.4% undervalued. Those of you that have been here a little while know that I like to look at the price to book ratio. Now, book value is just the company's assets minus any depreciation it has accumulated. Companies that are below 1 could be potentially viewed as undervalued, where those with a higher price to book ratio may be trading at a premium. Taking a look at Pembina's, we can see that they trade at 1.2 price to book ratio, which is a little higher than we like to see, but when we compare it to one of their main competitors, Enbridge, who are a larger company with a very similar business model, they're trading at 1.4 price to book ratio. So in comparison, Pembina could be viewed as undervalued using this metric. Next up, we want to creep behind the door and see the recent insider trading. We can see a lot of buying since March, even though the general demand for the oil industry is down. Many of these purchases are by members of the board of directors and senior key executives. An important name here is my brother from another mother, Mr. J. Burrows, who has recently picked up a bunch of shares at $33.25. And this is important as he is the chief financial officer, so he's looking at all the numbers and thinking this is a great place to put his own capital. So taking a look at the 5-year chart for Pembina, we can see that they were growing gradually over the last 5 years. However, just like most companies, have dropped off hard in early 2020. So looking at the last year, we can see during their February highs, they were up at $53, dropped 61%. And over the last few months has recovered slightly, but they're still down 41.15 cents or $21.90. The oil and energy sector is beaten up right now and people want nothing to do with it. This is when the best time for investing for value and getting that great starting dividend yield really comes into play. When others are scared, that's when you go hard to the paint. So this is why this is my first recommendation for 2020. Next up is a part of Canada's telecommunications sector, and with only 3 big players, Rogers, Bell and Telus, you'll likely do well picking any of them. Today we look at Telus, which can be found under ticker symbol T.TO on the TSX or TU on the New York Stock Exchange. They currently have a 4.9% dividend, which pays $1.17 Canadian. So we know Telus is a telecommunications company, one of the leaders in Canada with 15.2 million customer connections. They offer a range of services including internet access, voice, entertainment, healthcare, video, and IPTV television. One thing I would like to mention here is how Telus have made the decision to focus less on media, in which Bell and Rogers have been pursuing heavily. The space is already very crowded, and cable, for example, is a dying service in which customers are dropping off like flies. This has allowed Telus to invest in other sectors such as their development for 5G and into Telus Health, which is Canada's largest healthcare IT provider. This includes things such as pharmacy management, digital healthcare tools for general practitioners, and digital health solutions and services for hospital that assist in enhancing productivity, communications, and patient care. They also have Telus International, which delivers innovative business process solutions such as cloud and administration services, security tools, and customer service platforms. Although Telus has been growing organically, they have been buying up other small companies heavily. During 2019, they acquired ADT Canada, which provides residential and business electronic security, fire protection, and other related alarm monitoring services. Then in early 2020, Telus completed the acquisition of Competence Call Center, which was their largest acquisition since they acquired ClearNet Communications in 2000. I really like to see how they're buying up strong companies related to the industry, which is accelerating their growth substantially. Taking a little gaze at their stock quote, we can see that today they closed at $23.82, up 9 cents on the day or 0.38%. They have a market cap of $30.585 billion. Their PE ratio over the trailing 12 months is 20.41. And in the same time period, their earnings per share is $1.17. Their 52-week range has been anywhere between $18.55 and $27.74, and they're currently paying out a 1.17 dividend or 4.9%. Telus has a very solid dividend growth and history. As we can see, back in 2009, they were paying out 5.6%, which was 0.475 Canadian. And in 2020, they're paying out $1.70 Canadian, which is 4.9%. Taking a look at their share price versus fair value, we can see that they're currently trading 49.7% undervalued, given their fair value is $47.22. Now onto their price to book ratio, we can see that they're trading at a 2.5 multiple, which may sound slightly concerning at first, but when we compare to the other big players in the market of Rogers and Bell, they are slightly below this. Again, I do like to look at companies' main competitors and other big players in the market because that can give you a better idea of how investors are valuing these companies in comparison to the value of their assets. Now let's peek behind the door at the recent insider trading, and we can see that Dougie French, the CFO, has been selling a little bit in the previous few months. However, overall the general consensus has been a buy. Taking a look at Telus over the last 5 years, we can see that they have been growing steadily, which is expected given the way that the company has been acquiring other companies. And then obviously as expected, the big drop in March. Now, if we're over here at the 1-year chart, we can see that in February, they dropped about 28% or $7.75. But they have recouped some of those gains, now down just under 14% or down $3.86 Canadian. Telus is my second pick today because I am a huge fan of their diversified investment strategy. I like the fact that they're not focused on the media sector. Although I do see value in the diversifying strategy of Bell and Rogers, I expect Telus to have better returns with the decisions that they're making. Our third and final pick for today's video is Fortis. Now, this stock is listed on both the New York Stock Exchange and the TSX under ticker symbol FTS. They're currently paying a 3.6% dividend, which equates to $1.91 Canadian. Fortis owns and operates 10 affiliated electric and gas operations that serve over 3.3 million customers in Canada, the United States, and the Caribbean. They are in 5 Canadian provinces, 9 US states, and 3 Caribbean countries. Fortis has extremely valuable assets worth $57 billion, 93% of this being electricity poles, wires, and natural gas lines. Fortis has focused on investment in transmission and distribution infrastructure to deliver energy from clean sources to their customers. Fortis is growing both organically and through acquisitions. The company has more than doubled its size with the successful acquisitions of US companies over the last 6 years. My favorite thing about Fortis is their regulated revenues. Regulated utilities accounts for 99% of the corporation's assets, with the remainder primarily attributable to non-regulated energy infrastructure. This allows for more than 82% of their revenues to be derived from regulated sources. So Fortis's earnings are primarily determined under the cost of service regulation with incentives of performance-based rates. So today, Fortis closed at $52.86. That's down 25 cents on the day, or 0.47%. They have a market cap of $24.559 billion, a PE ratio over the trailing 12 months of 19.88, and an earnings per share of $2.66. Their 52-week range has been anywhere between $41.52 and $59.28. And they're currently paying a $1.91 dividend, which is 3.6 dividend yield. Taking a look at Fortis's dividend growth and history, they have had 46 years of consecutive common share dividend payment increases and have pledged to grow dividends annually on average by 6% through 2024. Taking a look at the last 10 years, we can see that they've grown from $1.04, which was a 3.9% dividend yield, to $1.91, which is a 3.6% dividend yield. Then moving on to the share price versus fair value, we can see that their fair value is $89.62, making them 40.7% undervalued. Their price to book ratio is 1.4, which is a little higher than we'd like to see, but we can see there that the industry average is 1.8. Now, going undercover and getting the recent insider trading, we can see that it's buy. We got David Hutchins, the Chief Operations Officer, dropping over $500,000 into the company. And we also got James Reed, the Chief Legal Officer, continuing to make purchases. So Fortis over the last 5 years has been growing quite nicely, and we have seen a huge uptake since late 2018. Although Fortis is a part of many long-term contracts, they still did get hit in March. But if we take a look at it on a closer scale, we can see that from their March highs, they fell about 28.27%, but very quickly bounced back. And now if we fast forward to now, they're only down about 10%, or $5.97 Canadian from their February highs. Fortis is my last pick of the day because I know people are looking for those safer companies that are a bit more predictable, given all the uncertainty out in the market and the general economy at the moment. I have actually done a full analysis of this video where I do look at the financials as well. So if you haven't seen that, go ahead and click the video on the screen now to learn more about Fortis. So do you own any of these great dividend companies? Are you looking to buy them? Have you sold out of them? Why? Let me know in the comments below. I'd love to hear from you. So that's all for today, folks. Remember to like, comment, and subscribe to see videos similar to this one.